Next, let's have a look at the flow of funds through the market for loanable funds. In our case, the market for loanable funds will be the aggregate of all the financial markets. Remember, those are the markets for loans, the markets for bonds, and the stock markets. Let's have a look at this chart that illustrates the flow of funds. Here we have four participants: the households, the firms, and the government. These are domestic participants. And we also have the rest of the world. These participants are abroad. On the chart, we also see three types of markets. These are the factor markets, the markets for the factors of production. We also see the goods markets. These are the markets for goods and services. And the topic of the discussion today are the financial markets. These are the markets for funds, where borrowers and lenders meet and borrowers acquire funds from the lenders, from the savers, and pay interest for that. The sources of funds, the sources of capital in the market for loanable funds are as follows. Firstly, it's the household savings. These are denoted by the letter S on the chart. Household savings flow from the households to the financial markets. Secondly, government budget surplus is another source of funds. If the government collects more in taxes, denoted with a T on the chart, compared to how much the government spends in government expenditure, denoted with the letter G on the chart, then the government would have a budget surplus. On the other hand, of course, if the government spends more in government expenditure, G, rather than it collects in taxes, T, that would be a budget deficit, and that would not constitute a source of funds. Rather, it would require additional funds than provide them. And the next source of funds can be borrowing from the foreigners, borrowing from abroad. This borrowing can be denoted by the difference between imports, illustrated by letter M on the chart, and exports, shown by letter X on the chart. If much more equipment flows into the country from abroad compared to the exports of equipment to the rest of the world, that's akin to borrowing from the rest of the world. And that also can be a source of funds. Next, let's consider the interest rates. As we've already mentioned, a nominal interest rate is the amount that a lender receives in interest per year, expressed as a percentage of the amount of dollars lent, or the amount of dollars used to buy a financial asset that bears the interest. For example, if you buy a bond for $900 with a face value of $1,000, the extra interest you receive is that $100 compared to your original purchase price, that is 11%. However, there is a difference between nominal interest rate and the real interest rate. Imagine that within the year that you held the bond, the general prices have increased by, say, 4%. The $1,000 you receive cannot buy as much as it used to a year ago when you only started out with the investment into the bond. The purchasing power has reduced by that 4% since the general prices have increased by that 4%. In this case, your purchasing power after receiving that $1,000 doesn't grow by 11%, instead it increases by 7%. You've got 11% more money compared to the $900 used to buy the bond originally, but the purchasing power of the new amount is reduced by 4%. So in a simple version, although there is a more detailed version which we don't discuss here, real interest rate is the difference between the nominal interest rate, which is 11% in this example, and the inflation rate, which is 4% in this example. From the perspective of the borrower, the real interest rate is the cost of borrowing. Since the $1,000 that has to be returned is not as powerful as it used to be, it has less purchasing power. It might be easier for the company to return that amount. So not all of the 11% is actually the cost of borrowing. If together with the general price level, the prices of the products that the company produces also increased by 4%, then it's easy to see that the actual cost of borrowing for the company would be the real interest rate of 7%.